Testing. 1, 2, 3. All right. Good morning. How are you guys doing today? It is Thursday morning. And up in the upper left-hand corner, we have the S&P 500. In the upper right-hand corner, we have the Dow. In the bottom left-hand corner, we have the Russell. In the bottom right-hand corner, we have the NASDAQ. We are trading the futures market, and we're getting ready to put on an Iron Condor. I want to do it before the market opens because that's what we've been doing. Next week, we're going to wait until after the market opens before we put on our condors and our butterflies and our option strategies. But this week, we're just putting them on before the market opens, and I've got 3 minutes to get me an Iron Condor on here before the market opens. So we want to see what happens when we do that, right? We are in a learning environment. We are learning, and so we are going to put on an Iron Condor. You can see in here, I've drawn some lines. I've already got ahead of the game a little bit because I'm pressed on time. And you can see what I've done is I've drawn the channel. So this is the channel that's gone back all week. This channel has gone back, and the market's been kind of staying inside of this channel all week. And it did break out right here. We had a little crazy day yesterday. Lost money on that option yesterday, but I'm going to show you how that turned out. And then it broke out a little bit this morning here. This was 8 o'clock this morning. We had some news. So we had some news. We'll talk about that here in just a minute, and it caused the market to run out. And now it's right back almost dead center back into our channel. So we're going to go in and put on an Iron Condor. What is an Iron Condor? Well, it's very similar to an iron butterfly, but this time, instead of being right on top of each other, which is a straddle, we're going to put it on as a strangle. And so we're going to put a strangle on, and then we're going to buy some wings outside we're going to actually sell the strangle. We're not going to buy the strangle. We're going to sell the strangle. So we're going to collect the premium, and then we're going to put the wings on the outside to reduce our margin requirement and to increase our, it's going to actually reduce our profit potential because we have to pay for the insurance, right? But it's going to reduce our margin, and it's going to reduce our risk is what it's going to do. So let's go ahead and drop these things on here. This is where the market's currently trading right now, down here in the options chain. We got 2 minutes to get this thing on here. So let's go ahead and get it on here quick. I'm going to go out, and we're going to sell outside the channel. And I want to go out about right there. So I have 3 clicks inside and 1, 2, 3 clicks inside here. We're going to sell this one out here. So we have a nice wide channel outside of this white channel that we've got here. We're going to collect $132 on this one. We're going to collect $132 on that one. Now we need to buy our insurance policies. So we're going to go ahead and we're going to buy these 2 clicks outside. 2 clicks outside. We're going to buy those. And you can see I've got my Iron Condor on here. That is an Iron Condor. All right. So I'm just going to get in here. I'm going to see if I can mark it into this real thing quick. Give it to us. There we go. We got it. All right. So the bell's going to ring here in what? 1 minute and 22 seconds. All right. And the market's falling a little bit against us. So we are going to collect the premium. So this is an Iron Condor. And I feel a little bit better now that we got that on there before the bell rings. Next week, we're going to start putting these things on a little bit more strategically. All right. But this week, I just wanted to teach you what they were. I wanted to put them on there before the before the bell rings. And see if we can't get these things to make us a little bit of money. And I'm going to show you how that's happening. Now, you know what? I wanted to do more than one. I was going to put on like 3 of them because they're not very expensive. Making 130, 100. That's okay. We'll just do one here in the beginning. Next week, we can double up on them if we want to do more and take a bigger risk. But right now, we're just going to do one. We're going to come down here in our positions, and you can see that we paid our cost basis is $145. No big deal. Our margin amount is $346. So basically, you can consider this a $346 investment into the market. And we're going to have to sit on this thing. We're going to just let it sit until the market closes. All right. We're just watch it and see what happens. And I'll document it throughout the day because we won't stay online here the whole day to watch this thing. But I'll document it just like I did yesterday. I'm going to pull up that chart and show you what happened to that trade, our Iron Butterfly yesterday. The market did go a little crazy on us yesterday. And so that was yesterday's market right in here. And our Iron Butterfly did not do so well. Did not do so well. All right. So we're going to have to kind of watch this thing and see how it goes. But we'll compare and contrast. That's the whole idea, right? We want to compare an Iron Condor to an Iron Butterfly. And what do we have going on in the news? Is this market opened yet? It has. That's the opening bell. Let's open this thing up. So that's the S&P 500. The reason we trade the S&P 500 because it's got the most volume, most open interest. It's got most of the, that's where all the volume is for trading options. Not that we can't trade some of these other options. We can. Some of these other markets have options on them. They're just very thinly traded. But they'll pick up a little bit once we get into our 0 DTE. This one we got, Russell's got 0 DTE on it today. So we could actually trade some options on the Russell today with 0 DTE. You can see the volume and open interest picked up a little bit down here on the Russell on these options. Let's see how the NASDAQ's doing. The NASDAQ, we also have some 0 DTEs. They'll expire today. And we have another one that will expire tomorrow. Tomorrow's Friday, so we have one we could trade tomorrow too. So the NASDAQ, we got some 0 DTE. 0 DTE, of course, means 0 days until expiration. And it means they're just going to trade today and expire. And so you can see that the volume's picked up a little bit on the NASDAQ. So we got a little bit of volume, a little bit of open interest in here on this NASDAQ today. We could actually trade something on the NASDAQ with options if we wanted to. It's not very high. I wish it was a little higher, but it's still there. You can still do it. Your spread, let's come over here to just the calls. Let's see what a spread's. Let's see. The spread is $35, $70 for one option. Just to buy a call, you have to pay, it looks like 40, 50 bucks to get in on that spread on the NASDAQ. That's one of the reasons why we don't do them. All right. Let's look at the Dow. The Dow over here, nothing. Dead. Okay. So no trading options on the Dow. Not that you can't. They're there. They're just nobody trading it. Completely zeroed out. So you don't trade options on the Dow. So that's why we trade the S&P 500. You come over to the S&P, look at all the volume and open interest. Thousands of volume, thousands of open interest. This is where everybody's trading their options. And so that's why we're here trading our options at this location. All right. And there's our Iron Butterfly. If I open that up a little bit more, I'm going to open up this chart. Bring it up here. You can see way down. No, where is our other side of this thing? Oh, this is just the call side. That's why I've got to go to traditional. All right. So there's our Iron Butterfly. You can see up in here, this is the call side, and this is the put side. All right. So now you can see them on the screen up here, how they look in relationship to the actual overall market. So this is the call side up here. This is the put side down here. So what did we do? Now, if you remember, towards the first of the week, we did some straddles and some strangles. And we learned about buying straddles and buying strangles. We learned about selling straddles and selling strangles. So you collect the premium when you sell a straddle or a strangle. You pay the premium when you buy a straddle or a strangle. Now, a straddle and a strangle is a neutral position. What you're doing is you're coming in and you're saying, I don't know which direction the market's going to go. I don't think it's going to go anywhere. I think it's going to go sideways. Okay. So if you think the market's going to go sideways, then you would sell a straddle or a strangle and collect the premium. If you think the market's going to have a big breakout move, like it did yesterday, a big breakout move like this, then you would buy the straddle or the strangle. You'd pay the premium and collect when the market moved in your favor. Now, yesterday, we haven't been really kind of timing these. We've just been learning what they are. And I've just been putting them on randomly, haven't really been analyzing too much. We've just been learning them in progression. And so we're just been putting them on first thing before the opening bell. Now, if you think the market's going to have some good news or some big news, we would not want to put on a neutral options position. All right. And yesterday we had the Fed was speaking and we said, well, maybe we shouldn't be putting this on today because the Fed's speaking. It's going to make the market move. I said, well, we're going to put it on anyway because we're in a learning environment and we're just learning what they are. And it's oftentimes a better lesson if they lose money than if they make money, because you can see, we're all, it's wonderful to make money. We love that. But we're all concerned about what happens when we lose money. And so how much money do we lose? What kind of thing can this cause? What kind of stress can this cause me? What do I have to do if I am losing money? How do I handle it? And so losing money in an educational environment is oftentimes more advantageous to us. We can learn more from a losing trade than we can from a winning trade. So had we made money yesterday, I would be able to show you, well, this is what the options made. Well, and we made money on the one previous, right? We made $700 on the one previous where we sold some options. This time we lost $250, I think. So we made $700 when we sold them. We lost $200 when we put on the Iron Butterfly. And I'll show you that here in just a minute. We'll pull that up and we'll look at it. But now we want to learn what an Iron Condor is. So an Iron Condor is very similar to an Iron Butterfly. in the sense that you're selling options to collect the premium. And the ones that we sell when we are collecting premium on an iron butterfly are the ones that are right at the money when we put it on, right? We put those sell options, the straddle, we put the straddle right on top of each other, but we sell the straddle. So we're putting it right on top of each other. That's an iron butterfly. And then we put the wings out there to protect us against a big move in the market. So that's the iron butterfly. The iron condor is exactly the same thing, only instead of selling a strangle, instead of selling a straddle, we sell a strangle. So I always get those two confused because they're backwards. A straddle to me should be the one where they're outside like this. This is a straddle. We're straddling the price. We got one option above it, one option below it. That should be a straddle. But they named them backwards. So in my brain, I always have to go, okay, which one's backwards? So the straddle is actually the one that's on top of each other when you put your orders right on top of each other at the money and sell them or buy them. If you buy it and go long, that's a long straddle. If you sell them, that's a short straddle. So we've done both in this class. And if you're just meeting with us for the first time, you can go back and watch those videos past this week. I had somebody asking me if they could join. And I said, absolutely, come and join us in our class. This is a class for the university. I'm a university teacher and I'm teaching these classes. This is the lab for those university classes. And anybody's welcome to come and join. It's on YouTube. Why not? Come and join. We try to do it in a number of places. We try to go to the library and have these classes. We try to go to we even went to a guy's hangar at the airport to have our labs, and people would come to the hangar and we'd all hang out in there and try and have the labs to trade, because I can't trade at the university because they're night classes and the market's closed. So I've been trying to have a place where we could go trade, and I just decided to just do it on YouTube land. That's where all the technology is. Just do it on YouTube. So we got the ability to project it out to the world, project it out to all the students. If the students can't come and make it in the first thing in the morning, they can watch the replay on YouTube. And so I just decided to just do it on YouTube. So everybody's welcome, but that's what we're doing here. This is the lab for the university, and we're learning about options because the options class is the one that we just taught. And so we're learning our progression. We started off just doing buys, buy a call, sell a call, buy a put, sell a put. And then we started going through some different strategies. What if the market, I don't know which direction the market's going to go. I just want to buy a call and a put. Okay. If we're going to do that, there's different ways to put that on. That's the straddles and strangles. So we went down the progress of straddles and strangles. And then the next natural progression from a straddle and a strangle is a iron butterfly and an iron condor. Those are just the natural progressions. Now, tomorrow we're going to talk about just doing one side of it, which would be a bull call spread or a bear call. Bear call spread would be selling a option, just the outsides of it without having the other side. Okay, so bull call spread would be, we would anticipate the market rising. We would buy the outer wing, and that's all that would be. Okay, so if you're only doing one side, it's the outer wing, that would be a bull call spread. This would be a bear put spread, right? So, or a bull put spread. We would buy it'd be bear put spread because we think the market's going to go down. So we'd buy it. If we think the market's going to go up, it would be a bull put spread. Okay, so bullish, bearish. Bullish, we think the market's going up. Bearish, we think the market's going down. Are we buying the options or are we selling the options? So that would be whether it was a short or a long position. Okay, so that's how we do that. That's how we name them. Don't worry about the names. I mean, it's more important for you to just understand the concept of what's going on with the options than it is to learn all these funny names. The names are fun, all right? And everybody makes up names. There's only about 20. I was going to look at that yesterday. I think it's 21 exchange recognized option strategies. There's really only about 21, all right? But there's about 1 million different variations. And so this is the options encyclopedia. If you want to get into the options encyclopedia, this is the book you want. Okay, it's the best options book on the market. It's written by Carly Garner. I don't know if you can, look, there we go. Trading, this is trading commodities, trading commodity options. All right, with creativity. That's kind of the key right there, with creativity. Look at that market drop on us. That's not good for an iron condor. You want that thing not to do anything. You want it to just die. Say, trading commodity options with Carly Garner. Carly Garner, right there. This is the best book on options you can ever get. Okay, and look how thick it is. It's a big, thick book. There's a lot of different option strategies that you can play. It's a big book. 8.5 by 11, big book, beautiful book, best book you could get. Did I push that hard enough for you? That's a good book on options. You just get it on Amazon. It's like $20. Can't believe she gives it away for $20. She's not making any money. So that's a good book, and it'll help you understand options in a way that no other book will. It's the only book you'll need to buy. So if you're like, I'm going to go buy me a book on options, that's the only one you need. Okay. So saved you a whole bunch of money right there. All right. So what we're looking at is Iron Condor. Let's go say hi to some people. We're going to look at the other markets, and we'll come back and talk a little bit more about our Iron Condor. I do have some PowerPoint presentation to talk to you, show you a little bit of PowerPoint. This 1 minute chart here on the NASDAQ seems to be the one that's moving the most, but it's still not moving. Well, let's draw a channel on there. Oh, that's a big move. That's $1,000. That's a big move. That is a big move. So that's a $1,000 move in 1, 2, 3, 4, 5, 6, 7 bars in 7 minutes. Now I did a Sunday trade last Sunday, and the market moved $1,000 in it took about 4 hours. About 4 hours for it to move $1,000. And this market has moved $1,000 in 5 minutes. 1, 2, 3, 4, 5, 6, 7, 8 minutes. $1,000 in 8 minutes. I had somebody ask me, they said, can you tell us a little bit more about that Sunday trade? I can tell you a little bit more about it. It was real simple. Sunday, the market's open, all right, in the futures market. So just Sunday afternoon, the market's open. So we have an opening bail in Sunday afternoon in the futures market. So I went in, and it opens, and it's not anything like this, okay? It just kind of pops out of the gate and just kind of moves real slow. And it just opens up, and the little tickers just kind of start to move. But I watched it for a minute, and it gave me a sell signal. So I was like, okay, well, let's take the sell signal. And it was just off the ATR. So it was right out of the gate, ATR, popped on the one contract. The market kept moving in my favor a little bit. So I was like, okay, well, it's moving in my favor. I'm going to put on a second contract. Boom. Just put on a second contract because it just kept kind of moving in my favor a little bit. And then I just put my stop in for 2, and it moved itself. The market just kept moving a little bit slow, and I brought my stop to break even, put it just inside break even. That was it. All done. And it's moving slow. So it's not like this, $1,000 in 8 minutes. No, it took 5 hours for it to move $1,000, but it did. It moved $1,000 down. It pulled back about $300 and then turned around and started to fall again. Now I wasn't watching it. I walked away, had my stop at break even. I said, I'm just going to let it go. I'll come back in a couple hours and see what it's done. If it stops me out in that middle of the time, so what? It's a scratch trade. No big deal. Who cares? And then I came back, and it had dropped $1,000, and my stop was still at break even. And then it'd come back against me about $300, and then it turned and started to fall again. And so I dropped my stop all the way down to where it started falling again and just trailed on the little green dots and said, okay, well, just trail me out those 2 contracts. I put 2 contracts in, trailed me out. And so ended up making $2,000, $1,000 move in 4 or 5 hours. But because I had 2 contracts, it was $2,000. And that was a pretty simple trade. That was all I did. Wasn't nothing. No Michael Jordan moves there. That was a pure high school kid, basketball kid trade. It's really a simple little trade. Just trade the morning bail right out of the gate on a Sunday afternoon and let the market move through its, the little choppiness, because it gets choppy. The only time you have these real smooth moves like this, well, not the only time, but the time you get these smooth moves is usually in the morning session, between now and noon on these markets. And then usually it's pretty choppy after that. We'll get some choppy stuff in here too. But I mean, look at the Dow. It's really nasty and choppy right now. So that's a real nasty, choppy market. And the S&P, we've got our Iron Condor on here. Now, this is a 15-minute chart. We could come down here and look at a 1-minute chart or a 2-minute chart to try and give us a little bit of an idea what this market's doing. So there's our Iron Condor on a 2-minute chart. So we put that thing on right here at just before the bell opened, and it's dropped like a rock out of the bottom of that thing. So if we were day trading, we'd think, hey, that's pretty cool. We're making $650. But in our Iron Condor, we're collecting premium, right? We're not trading like the move of the market. We want the market to die. We want it to just go sideways. Stay inside this box right here. Let me pull this. Oh, no, it's not what I wanted to do. So we got a box in here. How big is the box on a 2-minute chart? Oh, it's way out there, 11, 12 o'clock. It's going to have to stay inside there for a long time. So that's why we look at it on a 5-minute chart maybe. There's our expiration, and there's our box. So it's got to stay inside this box right here, basically right here. Now, that's not the exact numbers, but that's pretty darn close, within a few dollars. That's where that market's got to stay. It's got to stay inside that box for us to make money with this Iron Condor. All right. So if it leaves the box, then we start losing more money. We lose all of our money. And it can leave the box as long as it comes back in. It's just got to come back into the box. It's got to stay inside. It's got to hit that purple line inside that box. So we have what we call our cone of probability, right? So the cone of probability is like this. So it's from where we got into the market, basically right here. And we want to be dead center on this thing, which we were off center, it looks like, just a little bit. Let's measure it to be a little bit more accurate. We're going to use our 50% tool, and we'll go from here to here. So there's our 50% right there. So that's about halfway between. So there's our cone of probability. The market has to stay inside that cone of probability, or it's going to show a loss. Now, that cone's not perfect. This is everything we're doing here is just kind of a swag, a scientific wild ass guess. If we want to get perfect numbers, all right, hey, Lan, I want to know exactly how much our option is going to be valued at that point of price and time. Can you tell me what my option is going to be at that price and time in this mathematical model? Well, that's very hard to calculate. It's really hard to calculate because delta, the price of the options, are going to increase and decrease, implied volatility, all the stuff we talked about when we talked about the Black-Scholes model is taken into consideration to figure that out. Can we figure it out? Yeah, we can figure it out. And I'll show you a software program that does that. It's not Track and Trade. It's not almost any other program. We all do all of our calculations at break even. How much is it going to be at break even? Because at break even, all things are the same. So all options are delta of 100 or 1.0, which is the same as the underlying contract. It's delta of 1.0. So all options go to 1.0 at expiration. So we can always tell you at expiration what it's going to be because it's the same as the underlying contract, and that's easy for us to measure. We know how to do that. It's easy. We got a dollar calculator. We draw it on the screen. Everything's calculated at break even. But if you wanted to know how much your option was going to be valued at that inside that circle at that time, if the price was right there, how much money would I be making? How much money would I be losing? There are some mathematical models that can tell you that. And again, it's just a little utility that you can get on the web, and we're going to go talk about that. We can talk about that. All right. The problem is it doesn't work. The little utility that I'm aware of doesn't work in the futures market. It only works in the stock market. So we have to go over and look at our stocks versions of the software, look at our stock options, which we need to do today. We looked at them yesterday a little bit. We need to go and review those a little bit, see how our stocks are doing how our options are doing in the stock market, because that's another thing we're learning about. Longer term options, not these day trading options. We're doing both. We're trying to learn a little bit about both. But that software utility is only for the stock market, not for futures. So we have to do it the old-fashioned way. We have to come in here and we have to just kind of measure, and we got our prices in here. We know how much money we're receiving. So when we sell put on an Iron Condor, we're selling premium. All right. So we're selling and we're collecting the premium. So we put that on, which means we immediately received $130. For for that one, and we received $137 for that one. The minute you sell those, boom, they put that money in your account. You go down to your positions, and you can see that you received that money. It's in your account. You go to your trading window. Well, it's not closed out. It's not realized gains. It's in down here. So they give it to you immediately, and you can go spend it. What do we spend it on? Well, we spend it to buy our wings out here, our insurance policy. Now, just like we did yesterday when we put on an iron butterfly, the Iron Condor, again, it's the exact same thing. The only difference is that we have a big gap between them. And so if we were to put on an iron butterfly, let's come in and look. Right now, the options at the money, right here at the money, are trading at $400 and respectively. $400 for the call, $400 for the put. All right, so a $400 call and a $400 put right there. So if we sold those, we'd be making $800. All right, but our box would be smaller. Basically, our box would be a little smaller, right? Our box is bigger, but we're paying less for it too. So we have a bigger box when we do an Iron Condor. Now, it doesn't have to be bigger. We can make those, we can sell them closer to the money. And if we sold them closer to the money, we'd be making more money, right? So we sold this one and collected. What did we collect? It's currently trading at 150 and 65, and we sold them. Go to our positions. We sold them for 137 and 130. So we collected $267.50. $267.50 is what we collected in premium when we sold those two options. So 130 plus 137.50 to 67.50. Now, this option is currently worth $57 or 60 bucks. That's LV stands for liquidate value. So that's telling you what the current value of that option is. Now we sold it for 130. The current value is 60, 70 bucks. So that means we're making $60. Okay. You see that represented down here in your accounting window. We're making $60. Now down here, we received $137.50. The value of that option is now currently $147, which means we're losing $12. If we were to liquidate it right now, we would have to give back everything we've made, $137.50 plus $7.50. Okay, so we'd have to give back what they gave us. So when we sell it, they give it to us immediately. That's the name of the game. They give it to us immediately. It's ours. We sold them, they're ours. Now, that option can change value throughout the day. And if we want to give it back, well, we're going to have to give it back at the current value. So we give it back at the current value. And in this case, the current value is 140. So we'd have to give back our $137.50 plus the $250, or in this case, $255 additional. We'd have to give them back because it's worth more than what we received for it. That's how that works. All right. So it doesn't change how much you got. You get your money. It changes how much you have to give back when you liquidate it. Now, what makes it decrease in value? Time decay, right? Because when we have an option, options are made up of two different types of value: intrinsic value and extrinsic value. Intrinsic value is the amount of money from where you bought an option to where it's currently trading. Okay, that's the intrinsic value. So you have intrinsic value. But when you sell an option, you collect the premium of that option, which is extrinsic value. That's the time value. So the time value, the only way you can make money collecting premium or selling options is for the time to decay. All right, that time value, that extrinsic value, it's time value. So the way you make money is have time passage. Just by the passage of time, it will lose its value and give you money. Now, it can have intrinsic and extrinsic value. It can have intrinsic value too. So if it starts to go in the other direction and goes against you, the intrinsic value will increase the value of that option. That's why you have to give back more than what they gave you, because now there's some intrinsic value in there that you have to pay back. Okay. So that's how it works. And then these outer wings out here, this is insurance policy. So we put those out there as just as an insurance policy, because remember, when you sell an option or you write an option, then you collect the premium. But when you sell an option, you have unlimited loss potential, because on the other side of that, when you buy an option, you have unlimited profit potential. So if you're the guy who sold the option to the guy who bought the option, the guy who bought the option has unlimited profit potential. That means since you gave him that, you have to take on that risk, which is the unlimited loss potential. And so you're like, well, why would anybody do that? I don't want unlimited loss potential and limited profit potential, because you have the limited profit potential and he has the limited loss potential, right? So if you are the one who's selling or writing, which is what we're doing here, we're writing these two inside options. We have unlimited loss potential, and we have limited profit potential. The max amount of money we can make is the amount of money, the premium that we collected. So we can only make $267.50. That's all we can make. That's our max profit. And we're going to actually make less than that, because then we went and bought options with the money we collected. We collected $267.50. Then we went and bought some options. We went and bought these outer wings. This is our insurance policy in case the market goes haywire on us and just breaks out and runs to the moon. If it does that, we don't want to have to be left with our unlimited loss potential, right? So we buy those, and now we have unlimited profit potential on those outside options, and they can make as much money as we'd be losing on the ones we sold. And there's a little bit of a buffer in there, because, you know, whenever you buy insurance, you don't buy 100% insurance. You have a little bit of a buffer, or you have a little bit of what we call in the insurance industry, we have, what is it? Now the word slipped my mind. drink your tea when you forget the word you're looking for. Deductible. All right. So deductible. We have a deductible in the insurance world. So when you buy insurance, you don't buy 100% insurance on your pickup truck that you're driving down the road. So you have a deductible. So that deductible is the distance between this option and this option. That's your deductible. Okay. Now, it depends on what that deductible is, how much you're willing to risk in case that market needs to continue to rally. Now, it's not a full $500, but that's the distance at expiration, $500. So you have all these little options working one with the other. So that's why it's a really good idea, rather than to use just the calculator, just to come in here and splat one on the screen, which you can do in Track and Trade and almost all other options trading platforms. You can just come in and grab one, splat it on the screen, and it'll put it on there for you. And you're like, well, I guess that's the best thing. And if you don't understand what each option is doing, you're going to probably get your hiney handed to you. So we don't want your hiney handed to you by the market. So I want you to learn what each individual option is doing in each individual strategy and why we're putting it on. So this option up here is there, and we paid $55 for it as an insurance policy against this option here that we sold, so that we don't have unlimited loss potential. We only have a small deductible that we have to pay, because this option will start making money as much as this option is losing if the price goes all the way up there. Okay. Now it's going to start making money. This option will start making money because of the implied volatility. If this market starts to rally hard and starts to go up there, this will start making money as long as it's outside that cone of probability, right? So that's kind of how that works. It's an insurance policy. It keeps us from having to have a huge margin requirement. What's our margin on here? Our used margin on here, look at this, $346. That's nothing. $346. We have to have $1,000 margin to put on a single contract in the market, right? $1,000 to put on a single contract. So to have 4 options and only have to put up $346, that's not a big deal. We could do 2 or 3 of these, right, for $1,000. I was going to do 3 of them. I only did 1. That's all right. If we'd have done 3 of them, it'd be exactly the same thing multiplied by 3. Now, you can see right now, this market's come right back dead center, not quite dead center, but right back into almost right there into our cone of probability. Can you guys see that? So right there into our cone of probability. And if it would go right in there, we'd be at max profit. Max profit would be right dead center of that cone of probability. And it hit it there for a second. So let's draw a line at our max profit zone right there. And look where it's at. It's back there, right at that blue line, that volume weighted average price. Now remember, the VWAP, the volume weighted average price, is like a rubber band. The market's going to bounce back and forth across that rubber band if it's a neutral market. If it's a bullish market, it's going to go above that rubber band, that blue line, and it's going to stay above there. And it's never going to come down and touch it if it's a bullish market. If it's a bearish market, it's going to go below that blue line, and it's never going to come back and cross above it again. It's going to stay below that blue line. That is a bearish market. That blue line tells you whether you're in a bearish or a bullish market. But in a neutral market, it'll just sit there and wander back and forth across that blue line. It'll break above it, and it'll break below it, it'll break above it, it'll break below it. It comes down and it teases that little blue line. If it's just constantly teasing that blue line, it's a dead neutral market. And that's the kind of market that you want to put on an Iron Condor. And you're like, but Lan, how do I know it's going to be a dead neutral market or not? Well, it's you swag. You make a scientific wild ass guess. Nobody knows, but we can make a wild ass guess on whether it's going to be a neutral market or not. And the way we do that is we look at our news events, right? So let's pull up our news. And this is our news events for today. 6:30 this morning, we had a nasty news event. That red means that it's going to move the market. GDP growth rate, quarter over quarter, second established. That was yesterday. Let's refresh this. That was a big move. That's what caused the market to move yesterday. And that's what caused us to lose money because we put on a neutral option strategy when there was a big red market mover. And that's really what kind of caused it. That, of course, the GDP, yeah, it's one of those things, again, GDP was high. I couldn't believe it. It was over 5%. That's rocking and rolling. That's killing it, man. If our U.S. GDP is over 5%, that's Donald Trump numbers. I mean, Barack Obama never had anything over like 2%. For the whole 8 years he was in there. It might have broke above there a couple of times, but for the most part, he barely could break. The whole U.S. economy never broke above like 2% for the whole time he was in office, 8 years. And we had that really beautiful, nice growth. I mean, if you go look at the S&P, it was one of the most beautiful trending up markets you've ever seen. Donald Trump got in there and we never dropped below 5%. I mean, it was just like on fire, right? It was a rocket ship. And so we had fives all the time. And then it died. It went clear down. Biden got in there. We had the coronavirus, everything, all that struggle those first couple of years, and it dropped all the way down into the negative numbers. We had nasty, nasty growth here in the U.S. And now it's turned around. We're back at 5% again, 5% growth. Can you believe that? That's unbelievable. Even with all of our troubles and everything, I think that's, go to war, man. That's good for the U.S. economy. Go to war. So anyway, not good for people, good for a government, good for U.S. economy. All right. So anyway, nonetheless, we come in here 6:30 this morning. We had personal income month over month. The thing is that the market dropped after that yesterday and it dropped down. So we had a really big run after that news and then it flushed back down. So I don't know what's with that. So I always say it's not for us to determine how this news is, whether it's good news or bad news, because the big boys are the ones who decide whether this is good news or bad news. All we need to do is decide whether we think it's going to move the market or not, and then let them decide which direction. We're just that bothersome little gnat, that little fly that sits on the elephant's behind, and we go for a ride. So it's not for us to determine whether news is a positive or a negative thing to the market. So we just want to know that it's going to move the market. And this is the news for today. 6:30 this morning, we had some big news movers. And then we got 6:30, 7:05. We had Fed Williams speak. That was before we put on our Iron Condor. 7:45, Chicago PMI came out. So the PMI, that one is a nice barometer. What is also known as the Chicago PMI climbed to 55.8. Whether that's positive or negative, the only way we're going to know is by going back and looking at the market. And I think that's the Purchasing Managers Index. That's what PMI stands for. All right, Purchasing Managers Index. So we're going to come in here and take a look at this. And the Purchasing Managers Index came out at that came out at 6:30 this morning. So that was before the market opened. Fed Williams speaks at 7 o'clock. That's already happened. Pending home sales at 8 o'clock. So this is what's moving it now. So that's what that was. Pending home sales 8 o'clock. That's what just happened. So down 1.5. Pending home sales year over year. Still waiting for it to give us the number. So there it is, 8.5. So 8.5 down. So that's bad. That's bad news. Now, is it going to cause the market to fall? Yes, the market is falling. So it took it as bad news and down the market goes. Okay, so because it rallied back up, got us to our break even, and now it's falling back down again, we're down $7.50. We're losing $7.50. It's still inside of our box, but it's outside of our cone. So the cone is small in the beginning, right? The cone is very small in the beginning. That's called convexity. All right. As time goes by, the cone will get bigger and bigger in our favor. But the market has more time to leave the cone and leave the box. So that's the game we're playing. The game we're playing is that we can take a risk and lose some money up front in hopes that this market just stays neutral and goes into a bigger plane out here and goes and stays in here with our bigger box at the end. Okay. So that's what we're playing. So now look, we're back up $12, $15. What's the max we can make on here? Well, it's the cost basis, $145 in this case. That's our max profit, because we got to collect the premium of $137.50 on the put. We're going to collect the premium of $130 on the call. We have to pay for the insurance premiums, which are $67.50 and $55. Once we pay for those, the money that we got left over is $145, and that's how much money we get to keep. All right, the current value is 135 on the current value of these options. So now the difference between the current value and the cost basis is our profit, and that comes out down here on the total gain. You can see a percent gain. We're up 6%, 7%, which is $10. Now, 10%, that's pretty darn good. That's pretty darn good. Go down here to Old Cache Valley Bank. Go down here to Bank of Utah and ask them, say, I would like to put my money in your account, and in the next 1, 2, 3, 4, 5, 6, 7. In the next 70 minutes, in the next hour, I would like to give you to give me 10% return in the next hour. What is the Old Cache Valley Bank going to tell you? It's going to take you a whole year to get 1.1%. What are you talking about, Lan? You're nuts. I ain't giving you 10% return on your money in 4 hours. Well, I can get that in the stock market. Well, go do that then. Go see if you can do that. All right. Well, I'm going to make you wait an entire year to get 2%. If you put your money in my savings account. How many of you know millionaires who became millionaires by putting their money in a bank savings account? None of you. People don't get rich putting their money in a bank savings account. They get rich and then they put their money in the bank savings account because then it's safe. It's not going to lose it all, right? Because we have, just because you can make a lot of money fast, you can lose a lot of money fast too. And that brings me up to our yesterday's trade. We need to go look at how much money we lost yesterday. But before we do that, let's jump in and say hi to everybody. We got a few comments in here. We got people saying hello. So let's say hi to a few people. Let's come in here. This is B. Taylor. Good to see you, B. Taylor. Good morning to everyone. Glad you made it. Bruce R. Glad you made it. I recognize a lot of your guys in here. A lot of guys say, we got a lot more people watching and joining the class. I can see how many people are watching at any given time. I don't know who they are. I don't have your names. I don't have your contact. I don't have any of that. I can just see how many eyes we've got watching us. And we got a whole lot more eyes watching us than what have said hello. So if you guys want to add in and say hello, stick your little icon in there, say hello, and I'll make you famous. Gary Thomas, good to see you. Larry McIntosh, glad to have you. And then we got Gee Whiz. Larry, I saw that you signed up for class again. Starts on Monday. Looking forward to seeing you there. Gee whiz, happy Thursday morning to all. We got Matt's in the house. Good morning, Lan and all. Glad to have you, Matt. We got Selena Pavlovic. Good to see you, Selena. A lot of our regulars in here. Thomas Shaw. Good morning, Thomas Shaw. It's glad to have you. We got John Mackey. Good to see you, John. We got Kirk Schwartz. Good morning, folks. We got Michael Bruce. Good old Michael Bruce. Nice to see you, Michael. And then we got John David Lundberg. Great day to all. And then we got Selena Pavlik saying, got to leave. Come back to the video later today. Have a great day, everyone. Oh, we'll see you, Selena. So at least you can come back and see that we said hi to you once again. And then we got Ben Corpus. Good morning, Lance. Nice to see you. All right. The rest of you guys who haven't said hello, if you want to stick your little icons up there, we'll come back and we'll say hello to you guys too. So we got a good little class in here today. It's great to have everybody. And nice to see everybody here. Let's go look at our trade that we did yesterday, should we? Okay. Oh, I got to turn that comment off. Okay. Let's go look at our trade from yesterday. Let's see. How do I get that up here? Oh, that's not the way. I got it saved in my YouTube folder. Iron Butterfly, short options trade. Iron Butterfly. That's the one it was, right? So Iron Butterfly. Yep. Okay. I'll make it go full screen. This is what we put on yesterday. This was the Iron Butterfly. You can see that we've got the two options that we sold at the money. And our box, that was our box. It was a pretty big box, pretty wide box. But this market moved hard yesterday, and it moved outside that box. We received $362.50. We received $440. We put on our outside insurance policies. We paid $155. We paid $180 or $130 for that one. And then we got to collect that $400, $500, $600, $700 and something dollars. And then we had our insurance policies on there. So at this point, you can see the market was just outside the cone of probability a little bit. We were still up $15 because we were into the box quite a ways. So the market had moved quite significantly from when we bought it. We bought them, or we sold them. When we put this thing on, we sold them before the market opened. This was the opening rally, and this is a 15-minute chart, so each bar represents 15 minutes, and it jumped all over the place. It went crazy. And I thought it might just kind of wander sideways after that, but it didn't. We got some more news, and the market dropped and tanked out the bottom of this thing, came back down into the previous day's channel. So at this point, we're up $15. Let's go to the next one. Market moved forward, and we had this big flush right here. And look what that did to us. We're down $77 at that point. So this market flushed really hard, came down $77 down. And that's just great to see because, again, like I said before, sometimes a losing trade is more, I mean, we learn more from a losing trade than we can in a winning trade. If that thing would have just stayed in the cone of probability and wandered sideways, and we just said, hey, we made a whole bunch of money, wonderful, 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 aren't we really smart? Then we don't really learn anything other than, hey, you can make money at these things. It's better if we actually do have a loser so that we can learn how much money can you lose? I mean, what kind of risk are you putting on? I mean, if you were to have done a contract right here and that thing dropped, you'd be down $1,000. But what are we down? $77. And our max profit on this thing is $4, $5, $6, $7, almost $800. Well, no, because you got to take about $600 was our max profit. Okay, $595. That was how much we could have made on this thing had it stayed inside of our box. All I had to do is stay inside that yellow box and touch that purple line inside that yellow box. We'd have made $700, $600, which is what we did the day before, right? We put on a straddle and a strangle and we sold those and collected the premium. We made $700. So the fact that so far we're down only $77 on this iron butterfly, well, that's pretty cool. All right. Something good to know. Now it pulled back in. Look, it dropped all the way out of the box, came all the way down. I think we were down a couple $100 at that point, and then it pulled right back into the box again. Now, I was off working, doing other things, and so I wasn't focusing as hard on this one as I should have. I wish I'd have taken a picture of it when it was down here touching this low point to see how much it had gone down. But my bet is it was about $200. We were probably down about $200 at that point. So then the market started to rally and pull back in. So you can see with this, I took a picture of it because it was right back at break even, 0-0 total gain. So if you look at it, you analyze it a little bit, that sell call, the call that we sold was making us $350 because if you buy a call, you want the market to go up, right? You make money when the market goes up. If you sell a call, you want the market to go down. You make money when the market goes down. So in this case, we sold the call. That's why it's up $350. But you have a max profit you can make. All right. That's the other side of this. You're like, well, it's making money. If it keeps falling, I'll make more money. No, you won't. The max amount of money you can make is the $362.50 of the call of the. Actually, the call was $440. So the max amount of money we could make is $440. So that's why we need to have that put option or that put option that we bought down there to cover everything after that. So we have that buffer because we sold the put, right? Or we sold the call. And it's going to make $440, but then it stops making money. That's why you need to then have the put option that you buy because it has unlimited profit potential and it'll take over from there and it'll start making the money going down. That's how you cover your hiney. All right. You cover your hiney. If you don't cover your hiney, you have unlimited loss potential. That market has that buffer. It'll make you up to $440 to cover your losses. But at that point, once that 440 is reached, there's nothing down there. If you don't have that insurance policy, it can go and it can't cover you anymore. That's the best it can do. It can only cover you to 440. And then you got to have a put option down there, an insurance policy to take you the rest of the way. So then the market started to fall again. And you can see we're back down another $25 at that point. And then the market came down and it dropped all the way back out of the box again, going into, towards the afternoon session. Now I got a little confused in here. I kept coming in back and forth and doing other things and working on Pit News Magazine and going out and working on other stuff. And I kept coming back in and watching it. And I got confused when the close of the market was. And I thought that was the market was closing. I'm like, oh, the market's closing. I got to get out of this thing. And I don't know why my brain didn't. Yesterday, my brain was not on fire like usual. It was feeling a little sad and dumpy. So I don't know, maybe my vitamins didn't kick in. I don't know. But yesterday, I thought that was the stock market close, because this is the futures market doesn't close for an hour, a couple hours after the stock market closed, right? So I was like, well, we got to get out of this thing. Stock market's getting ready to close. So I came in and took the position off, thinking the stock market was closing, and it wasn't. I took it off an hour early. So I tagged that in there. Okay, stock market closed, but that's not where the stock market actually closed. Okay. Oh, let's see what just happened. I don't want that one. I just want this one. Okay, so that's where I said the stock market closed, but the stock market actually closed over here. So the total gain when we took it off, actually, I think we took it off. Yeah, we lost $260. So I took it off and lost $260, and I can't remember exactly where I took it off. It wasn't when the stock market closed, because I think I took it off a little bit before, and I like to do that. I generally like to take it off about an hour before power hour. And I think this was about an hour before power hour, and maybe that's what I was thinking. So I took it off at an hour before power hour. I was going to leave it on through power hour because this is a demonstration. It's not whatever. I took it off an hour. I took it off an hour before power hour. Had we left it on in power hour, we'd have probably lost more than the 260. So we lost $260 because power hour moves, right? And if it's moving against us, it's going to probably continue to move against us. I just took it off. But not always. Sometimes it'll turn and it'll come right back into the box in power hour. So you have to look at your technical analysis and decide whether you're bullish or bearish on the market, whether you think it's going to come back into the box or not, if it's outside the box. This thing had a down arrow. We had a down arrow. We were in a red arrow, bearish market. We got a down arrow. It came down. I was worried it was going to continue to flush. And I took it off when I thought the market was closing, but it was actually at the beginning of power hour, which was the right move anyway. We'd have lost more than $260, but yesterday we lost $260. That was what we lost. And so, yeah, we lost $260. So that's why, because it left the market. Now, if I was to draw a dollar calculator on there and say, well, we got into a single contract and went short or went long, how much would we have lost through there with a single contract? That'd have been several $1,000s. But in this case, because of the leverage that we had in our favor and against our favor, because we actually made some money, right? The sell call that we sold made us $435. So that one made us money. And then the buy put that we bought, that made us money, $482. So we made money. We had good option strategies on there that made us money. And then we had, the problem was that the put that we sold lost us $1,000, and the buy call that we bought lost us the full premium of $152. So we paid $155 for it. The max we paid for it, right? So the max we can lose is that premium, and that's what we lost, $152.50 out of that max profit of $155. So that's how that all played out yesterday. So we ended up losing $260. Not a big deal, because the day before we had an option strategy that won $750. So we had to give $260 back. All right. Not a big deal. So then the question comes in. It's like, well, Lan, why didn't you just do the buy put and the sell call that made money and not do the sell put and the buy call? Oh, good idea. But how do you know, right? We don't know. We can make our guesses. We can make our swag, our scientific wild ass guess, and we can just put on one side or the other side. And we're going to do some of that. All right. We're going to do some of that, but you got to kind of be good at picking market direction at that point again. So that's how you do that. You collect premium if the market is called a bull call spread or a bear put spread, and you're going to a short bull call spread or a short bear call spread, right? You got to get the little names right, but you're going to either put those things on or off, one side or the other, depending on whether you're going to buy it or sell it. If you think the market's going to go up, you're going to buy it. If you think the market's going to go down, you're going to sell it. So we can do some of those. Yes, we can do some of those. I call them chicken wings. All right, because oftentimes what happens is when you lose on these things, the market's in a trend and you're putting them on while the market's trending, and maybe the market's trending down, and you're putting these things on these neutral channels, and you keep losing to the downside every day. You're like, I lost again. I lost again. I lost again. I lost again. What the heck is wrong with me? Well, stop putting on the downside and just put on the upper side. All right. If the market, look at a longer term trend, go out and look at your daily chart. Is the market trending up or is the market trending down? If it's trending down, don't keep putting on that lower wing. Just keep putting on the upper wing and just keep collecting the premium on the way down from the upper wing. You can do that. Okay, that's called a bull call spread or a bear put spread, and whether you're going to be short on it or long on it, and then you have to reverse the bull call thing. But it's whether you're going to put it on and collect the premium, or whether you're going to put it on and anticipate the market's going to move. So whether you buy it or sell it. And then I call them chicken wings, because you're too chicken to put on the other side. So you're going to put on an Iron Condor, you're only just going to put on one side of it because you have your bias. I call it a chicken wing because you're chicken. You're too chicken to put on both sides, so you just put on one side. That's the chicken wing. That's my name for it. That's not going to, you're not going to go out to Chicago and walk into the exchange and say, hey, you guys, you know what a chicken wing is? They're going to laugh at you. No, that's Land Turner's name for it. All right. I got a lot of names. I call a lot of things different names. I've named a lot of stuff, my own stuff, but everybody does. We all have fun with these things because there's all kinds of fun names. So let's go back to the real world and close this one out. That's what happened. We lost $260. So if we come in here, pull up our little spreadsheet, you can see yesterday, I've got that in there, lost $260. Now this is the one where we made 627 on this one. We made another one on this. So we've got two options that we've made money on. Now that one, this day, this is where we did, this is my Sunday trade. So this was a Sunday trade where I put on two contracts, walked away, left the stop at break even, and let it ride all afternoon for 5 hours. Finally attached a trailing stop at the ATR, and it stopped me out with $2,765. Then for our Monday online YouTube class, I put on one long straddle and one long strangle as a demonstration to show the class how that worked. We lost $475 on those two strategies. The market was dead, went nowhere. Tomorrow we'll put on a short straddle and a short strangle. Okay, so that's what we did. That's how that turned out. So we lost money on those because we were anticipating the market actually moving because we bought the straddle and strangle. And then this one, we came in here. This is where we sold or rode a straddle and a strangle to compare the two. The market left our box due to news from the Fed, but then it returned right back into the max profit. We liquidated 10 minutes before the stock market closed. Because these were naked options, teaching a lesson on naked options, we had a $600 drawdown against our position. We had an $11,000 margin on each of these two strategies. Tomorrow we'll put on an iron butterfly, do the same thing, but with protection to reduce that outlay of 11 grand. But we did make $627 on that one. And this one, we have to come in here and we have to put our notes in here, new note, and we're going to write in here. So this was lost minus $260 against a iron butterfly where the market left our box and never returned, never to return. Them's the breaks. All right. So we lost 260 yesterday. Let's see what we can do. So we made on that one, on our options, we lost 475 on our options there. And we made 627 on our options there, and we lost 260 on our options here. Now, we haven't really been doing a lot of, right? We haven't really been doing a lot of timing on these. We've just been learning them. So, but we got to keep our account balance the same, right? So we got to come in here and we got to fill that in. That was a winner. Oh, that was a loser. Loser. Oh, yesterday. This one here was November 27th. That was a winner. Oh, this was 28th. Oh, I've already got it marked. So this is today. We don't want, oh wait, what's today? I'm getting my days mixed up. Today is the 30th. So we don't want to mark that one. Yesterday was a loser. This was a winner. We got to mark that one green. Green, and it was over $500. So we got to mark that a big one. Oh, then this was a winning day. Oh, that's the one. That's the one that's screwing us up. Our option lost, but our Sunday trade. So this was actually a losing day. I got it set as green, but in reality, it was red. We lost money on that day. That was a losing option day. This is a winning option day. This is a losing option day. Now we're going to see what we have today. All right. And then Sunday was our big winner. But I put that come out on November. We should break those apart, shouldn't we? I'll do that another time. All right. Back to the markets. So we're dead center again. We're back up $37. You're like, Len, I'm scared. I just want to take my $37 and walk away. Okay, do that. Go ahead. Take your $37, get out of it. But right now, you're sitting pretty. You're sitting pretty. You're inside you're sitting inside your cone of probability, and you're also inside your box. So this is where you're right where you want the market to be. You just want it to go all the way through here, and it's going to wander. It's not going to just stay flat all the way through there. Now that's what it does in the middle of the night, right? This is the middle of the night. That's what it does. So if you wanted to sell it in the middle of the night, of course, sell it on the close of the business and let it drag all night long, see what happens. Let's try that sometime, right? We want to learn what would happen if I did that. Can we do that? Yeah, you can do that. Let's try it sometime, see what happens. All right. Problem with that is we're not the only ones who thought of it. All right. Hey, I'll just buy them on the close and let them drag all night long and close them out before the market opens. And then, man, that thing will be flat. Good idea. Let's try that. See what happens. I can tell you a little bit because you're going to have a little foresight. They're going to charge you a lot of money for that because they know that too, right? They know the markets go flat in the middle of the night. So they're not going to let you get away with it. They're going to charge you more money on the close. And then all night long, all that time decay isn't going to take very much away. It'll just collapse back the implied volatility and you'll be back to where you were in the morning and you'll just start right up again. But we can try it. Let's try it because it's a good idea. Okay, we're going to try it and see what happens. I'll maybe put one onto those tonight. Well, today's Thursday. Tomorrow would be Friday. We could do it. On close of business and during power hour, I will try and come in and remember to put one on to decay overnight. All right, we'll try it and see what happens. So come back tomorrow morning, and we'll look and see what that overnight option. We'll put on an Iron Condor. Should we do a condor or a butterfly? Tell me in the comments below. Do you want me to put on an Iron Condor or an Iron Butterfly and have it decay over the middle of the night? Remember, if we put on a butterfly, right, we got a smaller cone of probability, but we make more money. We put on a Condor, we got a wider gap between there. We got a bigger box, bigger cone of probability, but we make less money. So the probability of us making money is greater, but it's smaller amount of money. So put in the comments below what you want me to put on there. Condor, or we can't do both. I mean, we could, but it gets messy when you do a condor and a butterfly at the same time. So we're going to keep it clean. Which one do you think I should put on? I'll tally them up and see who says what, and we'll put them on there just for fun. You guys can let me know, and we'll put one of those on. All right. Not in these comments. I want it out in the YouTube comments because the algorithm looks at that. They like it when you guys put stuff out there. They don't really care if you comment in here. They look at this and they're like, whatever. If you put it out there, they go, oh, wow, that's cool. He put it out there. Okay. And if you give me a thumbs up, if you like this class, if you like what we're learning, give me those little thumbs up because the YouTube guys, they like that too. Give me some thumbs up. Hey, we're making money. We're up $32. That deserves a thumbs up, right? What's our max profit potential? $145. So $145 is how much we can make if this thing will just hit that purple line inside that red box. That's all we need it to do. Just stay inside that big red box, hit that purple line, and we'll be golden. Make $346. No, $145. Sorry. $346 is our used margin. That's our max loss. So they're going to margin us at our max loss, which is $346. That's how much we could lose if this whole thing goes awry. But our profit is $145. That's the max money we can make. Okay. All right. So let's go back and look and see what some of these guys who are day trading are doing. Matt, how you doing on your day trading today? Are you still with us? The NASDAQ's been doing a little bit of a bouncing, making a few little moves, nice little moves. The Dow had that ugly morning. The Dow's been doing that lately, right? It's been having that really ugly morning. And then once it breaks, it goes. And so it's kind of had some nice moves. Not too good. Maybe been able to scalp a little bit out of that thing. But the NASDAQ kind of made some nice moves in there. How much was that? How much money? From this breakout here to this close, that was $685 on that move there. That's not bad. And how about this one from here to here, just to there? That's $650. How about from this one to this one? That was basically a scratch trade. So just from arrow to arrow on this NASDAQ, that was $660, $685. That's a scratch trade. You'd got bumped out right there. Market's getting weak. Started to drop, bumped you out right there. That'd have been your stop. Whether you'd have got back in to try and take the next leg down, who knows? And then from this one here, we already did this one. We already know that arrow down from that break right there, that little break, that little arrow, down it went. Where's our dollar calculator from entry to exit? Where we didn't get stopped out there, all the way to the bottom. $1,250 right out of the gate. But what time was that? That was 7:35. So that was a half an hour before the market opened. So the market didn't actually open until clear out here, 7:30. Oh, well, and these are also on the, well, this 1 minute chart. So, oh, that was just right before, oh, that was right, the opening bell, 7:30. Oh, the opening bell was actually back here. So yeah, you'd have gone long first, got stopped out with a loss, and then if you'd have taken the short position, that'd have been 1250. So that Nasdaq's been performing for us today, which has been rare lately. We haven't had a good Nasdaq, right? Nasdaq's not been very good lately. The Russell is the one who's usually been pretty good, but the Russell, a little sad and tired today. We're not doing well with the Russell. Although the arrows, yeah, it's not doing too well. We could draw a couple dollar calculators in there to see if we, I don't even see where we could have got in with the, we'd have got stopped out there with a loss. If you'd have got back in, that move on that was $335, but I don't think you'd have caught it. You'd have had to been really taking some risks to take that one. And then in a reversal, and then this one, if you got in on this one, might have been a little bit, but you get in here, and then it would have stopped you out about right there with about $110. So that's about the best you could get out of the Russell, but the 2 or 3 times you'd have tried to get in, you'd have lost more than you made. So I don't think that was a good trade today. The Dow breaking out right now, trying to run. Let's go over and look at our stock options, should we? Or our stock, yeah, our stock options, and then we'll let you go for the day. And I'll just let this run. I'll document it, take some pictures. We're up $42 right now. Okay, so we're pulling up our stocks version. Anybody have any favorite stocks they want to look at? We can go and analyze a couple of stocks for people if you got something going. But look at this market. Okay, let's come in here. Let's just start off with this one here. This is Netflix. We're going to go multi-leg. And you can see in here, we just bought 3 puts. That's all we did. 1 at the money, 1 out of the money, 1 far out of the money. And those are our cones of probability from yesterday. When we look at this, things are just not dropping. I thought we might get a reversal up here, but it's just going dead flat sideways. That'd been good for Iron Condors, right? Iron butterflies, but who thinks the market's going to do that? Usually we think it's going to go up and then it either turns and flushes or it turns and breaks and goes again. I still think it's bearish on this market. We've got till that purple line for these options to become profitable, but right now we're down $500. We're in a $500 drawdown because time is decaying on all 3 of these options. We're not making any money because the market's not giving us any intrinsic value and falling in our favor. So we're just losing time value as this thing marches towards the expiration date. We need it to flush real hard, and this would shoot right back up and we'd be profitable. But it's going to have to flush and it's going to have to move. It's going to have to get a big move. We'd like to see one of these going in the other direction, right? To make these put options profitable, the market would have to do this only in red bars down. And our indicator is telling us that that's what it should do. We're way up there on these red indicators. See the chalk and money flow, accumulation, distribution. Those things need to, this market needs a correction. It needs to fall. But right now you can see we're in a drawdown, $500. All right, let's go to our Apple chart. Apple's starting to fall a little bit, and we're having the same situation. We just bought a whole bunch of calls on this one, though. So we're in the money because we bought this one at the money right here. So this one here was in the money. This one here, or out of the money. This one was at the money, and this one was deep in the money. So you can see, once again, what's going on. We paid our cost basis for the one that was in the money was expensive, $1,655. It's a break even right now. It's not doing anything. Oh, just lost. That's down $2.50. So the buy call that was at the money, where we pay, oh, this was out of the money because it was a $325. We paid $325 for it. It's losing $64, and it's losing the largest percentage. 19% of it's gone, right? We've lost 20% of that call option. And then this one here is a cost basis of 870. That was the at the money, and it's down $47 because the market, although in our favor, it's losing. So it made all that intrinsic value, but the time value. So that's a situation where, again, we did the right thing. The market's rallying, and we're in the money. It's like, why is it losing money? Because time decay is taking away more money than what it's giving us in an extrinsic value. Time decay is decaying faster than the intrinsic value is gaining on that option. So you did the right thing. You got into your option, and you're still losing money. Okay. So the money market went in our favor, but now it's turned and started to fall. So that's why we're losing money. What's funny is that Netflix, we've got puts and it's losing money. So our puts are losing money on Netflix. Our calls are losing money on Apple. So that's the name of the beast. Let's come in here and look at how we're doing on Amazon. Amazon, we just bought a bunch of puts just like we did with Netflix. We bought one at the money, out of the money, and in the money. So in the money, this is the in the money one. So this is at the money and out of the money. And we're losing money on those too. So we bought all these puts and we're losing money. So Google, we bought a put and we bought did we buy? Yeah, we sold a put down here and we bought a call. So we bought a call and, we got one more up there. Keep forgetting that one. It's off the screen. So that one there, we sold. Sell a call. So we sold that. We're going to collect the premium, $110. It's currently worth $37. So we're up $72 or negative $37. So we're up $72. So that's the profitable ones. The one we sold and collect premium on. Well, there's a good lesson for us. Every time we bought the options, we've lost money. Every time we sold the options, so far, we've collected money. We've made money. This one here we bought. We bought it and we're down $200. We paid $680 for it. And the market's right back at where we got in. It made money a little bit here, or I don't know how much it did because time decay was decaying and intrinsic value was increasing. So it was probably staying break even or making a little bit of money. But now with today's flush on Google coming back down, that call option is going to lose money. Look at it's down $200. All right. This option, this is the one we sold and collect the premium. It's just got to stay below that red line. That's all the market has to do. Just has to stay below that red line. We get to collect our full $110. So that's cool. Now this is a put option that we sold. So that put option that we sold, we received 145 and the market value on it is currently 149. So we're losing $3.50. For this to be profitable, it just has to stay above that red line. All right. Now, the really cool thing about it, well, I'm not going to go into that right now. I was going to say by selling put options below the market, there's a really cool trick with those. But we're going to learn about that next week. All right. So come back next week and we'll learn about the really cool trick of selling put options. We're going to talk about that. All right. So Meta, we're up $185 on Meta. How are we making money on Meta? Well, we bought a put, and the put that we bought, look at that. The one we bought is losing $25. Time decay is killing it. Even though the market's falling in our favor, it's not falling fast enough to outperform time decay. It might. I mean, it might still keep going. It's got to go. It's got to drop. If Meta drops, that put option will start making money. But right now, it's losing money. And what's making us money? The one we sold. The premium collection right up here. We sold this one, collect the premium. All I have to do is stay below that red line. And we received $550 on that thing. They gave us $550. The market value on it's $325. So we're up $225. That's our profit right now. $227 on the option that we sold. Well, that's pretty cool. What are we learning here? Options that we buy, if the market doesn't move dramatically in our favor, they lose money faster than they make money. But if the markets, the ones that we're selling and collecting premium, we're making money on almost everything we're collecting premium on. And the one we're not making money, we're only losing a couple bucks. Selling premium seems to be a pretty good deal, right? That's what we're kind of learning here, isn't it? Selling premium seems to be a pretty good deal. So we're going to come in here and look at Netflix. We already looked at Netflix. The Qs. Let's look at the Qs. Now on the Qs, we bought and looks like we got two put options. This is a butterfly. We put on a butterfly. So we're up $8.50 on our butterfly. And that was a 5-day butterfly, wasn't it? That's what we put on there. How about that? This is our 5-day butterfly. Where's our expiration? That's a 1 minute. Let's go to 15 minute. So there we go. We're up $4 on our butterfly. What's the max we can make? The max we can make is 400 minus 32. Whoa, this is a pretty good deal. Cost basis is 413. So our max profit is $413. We're only sitting at $6.50 right now. But our sell call, the call that we sold, is making us 145. The put that we sold is losing 127 because the market's falling, right? So the put's losing money. But the put that we bought is making 1550. So that's our insurance policy that's helping us cover some of the loss on that put that we sold that's losing money. And then on the call that we bought, well, it's not being used at all, so it's losing. It's going to lose the full, it's down $20, but the max it can lose is only $31. So that's just an insurance policy that'll go away. But our call that we sold is making us $143. So add it all up, we're down $8. But we just need it to close inside that box, right? As long as it closes inside this box, probably somewhere close to right here. We could do the math and calculate it out, but it's probably something close to that. As long as it touches that, oh, and we got to go to the purple line. Boom, 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 and go this direction. It's out there. So we still got another couple of days. This thing has to go through the weekend. So we might close it out on Friday. We'll wait and see. We got, as long as it stays inside there, that Q, as long as it just keeps going sideways, it's got to make our max profit, it's got to hit that purple line inside the box. And that box is not where I drew it. We need that box to go here, here. Oh, let's drag it out all the way out to here. That's our profit box right in there somewhere. That's very close to it. And then this is our cone of probability. So as long as it stays inside of our cone of probability, we'll show profit. Leaves the cone of probability, will show a loss. But doesn't mean we'll lose money, just means it'll show a loss. So there's our cone of probability. That's why we're showing a loss right now, because it's not inside the cone of probability. It's sitting outside of it. So we're down $11.50. It needs to get inside that cone of probability to show profit. Now that cone of probability, that's a straight line cone. It's not actually a straight line. It's more of a curvy line. But again, I can show you the software next week that does that. All right, so stick with us. Come back. I'll show you some neat software that'll show you the values of options inside of these boxes and inside these cones. So we can play with that. It takes a long time to sit there and enter all the information in, so I don't want to go do one right now. It takes 20 minutes to get one done. But that's our cone. That's kind of where we're at, and that's why we're waiting for that thing to just stay inside that cone, and we'll make our full cost basis of $413. But we may close it out early. Close it out tomorrow before. Well, we can let it go through the weekend, close it out on Monday. We'll see. We'll have to see. We'll have to wait and see. We'll have to wait and see. Don't know. It's like Christmas, right? Presents are sitting under the tree and we can't open them yet. All right. Okay, let's come and see. Does anybody have any, look at BJK. So Michael Bruce says BJK. Let's go pull up Michael Bruce's BJK. Van Vector. So there you go. There's your 3-drive pattern. Drive 1, drive 2, drive 3. So there's your perfect little Elliott wave. So what happens with an Elliott wave? Generally speaking, X, 1, 2, 3, 4, 5. And then we're going to look for A. We'll get a pullback, B, and then we'll look for another rally up in here. So that would be our C. So that's what we're going to look for on Van Eck Vector Gaming. So we're going to look for this little ABC. We'll come in here with our ABC tool. We'll go off this bottom here up to this peak. Why do I choose this peak? Because it's the blue lines. The blue dots tell us where to, the peak above where it crossed the blue dots. So right here. So that goes down. How far down are we going to go? Well, we're going to anticipate somewhere into the Fibonacci sweet spot, right? So right down in this region here somewhere where I've kind of drawn it in there. There's 61.5. That's about as close as we're going to get to 61.8. So right there. So that would be if I take our Fibonacci ruler, Michael Bruce, we're going to come in with our Fibonacci ruler, draw that in there, and we're going to anticipate that it's going to come somewhere right down into this region here. And this is where we're going to look for it to turn in the Fibonacci sweet spot. And when we get it, we're going to get our spider web, right? We're going to look for a spider web to occur. So let's get rid of all this stuff. So our spider web should come in here. If I can click these buttons. Okay, so we're going to get a spider web. Let's grab our spider web tool, and we're going to get a natural trend line. You come down the natural trend line. That's what the first break, and then we'll have a mathematical trend line when it breaks the blue lights, and then we'll have the horizontal trend line when it breaks above the previous high. So those will be your locations for entry if you want to buy and go long on Van Eck Vectors. Funny name. So this thing's going to come down. This is what we would anticipate. It doesn't mean it can't. It can come down and it can do whatever it wants, right? Mark can do whatever it wants. But this is the probabilities that we're going to be playing against this market, rallying against this first drive up, and then we're going to drive down. So you can see the little Elliott wave inside. So you come in here. This is X. We went up 1, 2, 3, 4, 5. A, probably get a little B, A, B, C. Maybe get a little ABC in here, something like that. Then we get our drawdown there, and that's what we would look for. So not the prettiest, but it's pretty darn close, right straight out of the book. Right straight out of the book. So now we're just looking for that little turnaround spot right in here, and this is where we could go long on this market in anticipation of this next leg up. All right. All right, guys. That's a wrap for the day. We're going to let you go. We're going to jump back over to see oh, look at we're down $5. That thing's dropping out the bottom. So it's dropping out the bottom. We need it to rally and come back up into that cone. We're going to lose some money again today. But we'll watch. Next week, we're going to try and time these a little bit better. This week, we just wanted to learn what they were, just put them on. And next time, we'll start trading again. We'll try and be a little bit more serious about our trades and try and be a little bit more strategic about putting these things on. But right now, we're just learning and just putting them on to learn what they are. All right, guys, take care. We will see you tomorrow morning.